All right, let's talk about Sidus Space. We're going to dive deep and try to figure out if this company is a solid long-term investment. I mean, is this thing a rocket ship pointed straight at the moon, or is it about to burn up on re-entry? Let's get into it.
The whole commercial space scene is just blowing up right now. Seriously, with launch costs dropping and satellites getting smaller, it feels like we're in a brand new gold rush. We're talking about an industry that could leap from about $280 billion today to a mind-blowing $1.8 trillion by 2035. The upside is huge, but let's be real, so are the risks. It could just as easily be a black hole for your money.
So how in the world are you as an investor supposed to navigate all this? Well, we're going to pick one company, Sidus Space, and use it as our guide. Their story is a perfect example of what's happening out there. It's got this incredible, futuristic promise on one side and some pretty serious red flags on the other.
Okay, let's kick things off with the bull case, the optimistic view. And it all really boils down to the company's big idea, what they call space as a service. And honestly, it's a pretty game-changing concept.
Think about how it used to work. If you wanted to put something in orbit, you had to build an entire satellite from the ground up. It took years, cost millions, a total nightmare. Sidus just completely flips that script. They've basically created an Airbnb for space. Their LizzieSat platform lets customers just rent a spot for their gear. This smashes the cost and complexity, and for Sidus, it creates this beautiful recurring revenue stream.
And the tech making this happen is really cool. They're using these hybrid 3D printed structures that slash the satellite's weight by over 30%. And get this, on board, they have something called Feather Edge AI. It lets them do computing right there in orbit, which means they don't have to beam massive amounts of data back down to Earth. The whole system is just built to be super efficient and flexible.
Of course, a great idea is nothing without great people to make it happen. But when you look at the leadership at Sidus, well, it's like a tale of two completely different realities. First, let's talk about the pioneers.
So the company was founded by Carol Craig. She's a former naval aviator who started Sidus way back in 2012, and in 2021, she took it public, making it the very first space company founded and led by a woman to be publicly listed. That's a huge deal, and that kind of background is a massive plus, especially when you're trying to win government contracts in an industry that's all about relationships.
And look, they've been getting it done. Between 2024 and 2025, they got 3 of their LizzieSats launched and working, proving the whole concept works. They've landed some key partnerships. They even got the first ever commercial approval for non-Earth imaging, which is a big step towards more government work. Operationally, this team has definitely shown they know how to build things.
So the vision is awesome. The tech is cool. They can build the hardware. But that is only half the story. Because when you look at how the company has managed its finances, a much darker picture starts to emerge.
35.1 million. Just let that number sink in for a second. That's how many shares of this company existed in September 2025. Just 2 years before that, the number was 1 million.
Yeah, you heard that right. A 35 times increase in the number of shares in only 2 years. For anyone who invested early, this is just catastrophic. It means their slice of the pie, their ownership in the company, has been watered down to almost nothing. Management decided to fund everything by just printing more and more shares. And they did it at a pace that is just breathtaking.
And that brings us to the financial reality check. This is where the big, exciting vision smacks right into the cold, hard numbers. And to be blunt, it is not pretty.
Just look at the revenue. At the very same time they were flooding the market with new shares, their revenue was actually going down. It dropped from $6 million in 2023 to a projection of under $4 million for 2025. That is the exact opposite of what you'd expect or want to see from a company that's supposed to be in its growth phase.
And the gross margin? Oh boy, this tells an even scarier story. It went from a pretty healthy positive 28% in 2023 to a staggering negative 141% in 2025. What that means is the cost to even generate their revenue, things like their satellites losing value over time, are growing way faster than the money coming in. Right now, the business model just isn't working. It's losing money on every sale.
So what does all this add up to? It means the company is burning through cash at an unbelievable rate. Their annualized cash burn is over $20 million.
So when you put it all together, revenue going down, margins in a nosedive, and burning through cash like there's no tomorrow, the picture gets pretty stark. The money they have in the bank right now, it can probably only keep the lights on for another 2 quarters, maybe, which makes another round of fundraising and almost certainly more dilution for shareholders feel pretty much inevitable.
This all leads us to the final crucial question for any investment, the valuation.
Is the stock price based on reality, or is it just floating on a cloud of hype?
So, if you run the numbers, do a discounted cash flow analysis. Even giving them the benefit of the doubt on growth, the company's real intrinsic value comes out to about 45 cents a share. But the stock is trading at 5 to 6 times that price. There's just no margin of safety here, based on the fundamentals. The price on your screen seems totally disconnected from the financial reality of the business. Okay, so based on everything we've just seen, the fundamental case looks pretty terrible. But there's a whole other way to look at stocks that completely ignores all that stuff and just focuses on the chart. And from that perspective, what if the chart itself is telling a completely different and surprisingly bullish story?
Let's talk about something called Elliott wave theory for a second. It's a type of technical analysis, and the core idea is that stock prices don't move randomly. They move in these predictable, repeating patterns or waves that are driven by the collective psychology of investors, fear and greed.
Now, according to this theory, Sidus might have just finished what's called a corrective wave 2, which is usually a period of pessimism and low trading volume. People who believe in this stuff would argue that the stock could be on the verge of starting wave 3, and that's typically the longest, most powerful, most explosive upward move in the whole cycle. And you can see some signs of it on the chart, with the price recently jumping up on higher volume.
And here's the crazy part. If this wave 3 pattern actually plays out, the theory suggests a price target somewhere in the $7 to $8 range. I mean, that is a massive, massive jump from where it is now, and it's a universe away from the 45-cent fundamental valuation we just talked about.
So here we are, left with two stories that could not be more different. On one hand, you have the fundamentals, which paint a picture of a company with a great vision, but with really serious financial issues and a dangerously high stock price. And on the other hand, you have a chart pattern that suggests it could be about to go on an incredible bull run. So the question for any investor is, what do you bet on? The speculative pattern on a chart or the hard but currently troubled financial reality of the business? Which story do you believe?